The question is, if you already have a Roth that satisfied the 5-year clock, can you move any amount you want into that? For qualified distributions, that 5-year clock will apply to everything. Money you add to that Roth, or even money you add to a different Roth. And if you do a conversion and you have an existing Roth, there are reasons why you probably want to set it up into a new Roth until your recharacterization window closes, and then you merge them. For the 5-year clock on the conversion penalty, if you're under 59.5, that's a brand new one that just applies to that money. This is why it gets complicated. There's 2 different 5-year clocks. I almost wish they had made 1.6 and 1.5 or 1.4 and 1.5. It'd be easier to keep straight, but they're the same, so it makes it a little bit confusing. The question is, what was the goal behind creating this change, and was the goal to increase tax revenue? Absolutely. It was, and that's not speculation. It was there's a tax act called TIPRA that was passed, and the Roth conversion limit going away was in the revenue generation section of TIPRA. So it's not even, do you think they were trying to generate revenue? Absolutely. It was one of the budget tricks they made to make the 10-year number look better. That's why they did it now, because money at the end. For budget reasons, it looks better for them. But absolutely, that's why they did it. It's also why one of the questions I get sometimes is, do you think they will close the window on conversions? I don't think so. It is certainly possible. They can always change tax law. But the way I see it, Roth conversions generate tax revenue now at the expense of less tax revenue probably 20 to 30 years out, when a different set of Congress people are in office. The people now, I don't think, care. And also, I think you could make an argument that we probably need the money now. So I don't think they're going to close the window. The question is, isn't the assumption about future tax rates critical? And the answer is absolutely yes. And your second part was, since you don't know what future tax rates are, what do you do? 2 ways I would answer that. One is, we're at a very low tax rate historically. I believe that things tend to move back towards the long-term average. That would argue for tax rates going up. Secondly, I think it argues for a partial conversion, if you're considering a conversion, because there's 2 possibilities if I convert. Future tax rates could be higher, in which case converting to a Roth was a great idea. Future tax rates could be lower, in which case converting to a Roth was not a great idea. Having a little bit of both means that either way, some was not a great idea, some was a good idea. It just mitigates the chance that you're 100% wrong on your tax assumptions. But what I would talk about, and this is one that what you really want to do, is dig into what your retirement income stream is going to look like and where it's going to come from with your advisor. Because this is a very different question for a lot of different people. You know, if you have a large, let's say, municipal bond portfolio that you want to keep and you're drawing this tax-free income, that's what you want to spend in retirement, your tax rate's probably not that high, it's not going up. That's a different situation than somebody who has a large pension and a decent Social Security benefit and a large IRA. They're going to have a lot of taxable income, especially in late retirement, even if they don't need to spend it. I know it sounds like a dodge. There's no way around. You've got to dig into not just what your assets are, where they are, what your basis is. Well, what's our plan for generating retirement income? What type of income is it? Where is it coming from? The question is about basis. And what I mean by basis is, if you make an after-tax contribution into an IRA, so you didn't get to deduct it, you're not taxed on that money again when you take it out. That would just be more unfair than even the IRS will do. So The question is, how do you establish that and how do you figure out what it is? There's a form called Form 8606 that you file whenever you make a non-deductible contribution, and it also tracks what your cumulative basis is. That's the form that you want to look at. If your tax advisor did not file that for you, you haven't established basis, but luckily you can file that late, even beyond the 3-year usual window for filing a late form, but there is a fee attached to it for each year that you file late. But if you're using a tax advisor, they're generally on top of this. You just look at last year's 8606. It's probably a good idea. I would, if you have a copy of your tax return, bring that in when you talk to your advisor about what you should convert or not, because they can look it right up there. That's what your basis is, and it works out. The question is, if you have after-tax money in your IRAs and you also have a 401k balance, do you have to take the 401k balance into consideration? And the answer is no. That you only look at your IRAs. Though you have to look at traditional IRAs, simple IRAs, and SEP IRAs. All of those are grouped together. 401k assets aren't. It's one thing that you also want to be very careful of is if you have basis, doing a rollover from a 401k or a plan like that into your IRA after you convert in the same tax year can really mess you up. So what I always recommend, because right now I'm talking about Roth, the other presentation that I do a lot is IRA mistakes and mistakes people can make taking out money from their retirement plans. There are a lot of mistakes about taking money from a qualified plan that are unfixable. They just cause you to pay more in taxes than you should. What I recommend before you take a distribution from any retirement plan, get advice before you do it. Because there's a lot of situations where if it comes out in the wrong way, for very technical, minuscule reasons, it can crash some very interesting tax strategies.
Thanks, Dad.
Thank you.
I'm going to try that.
That one seems more reliable.
Seems to be a safer bet here. Thanks again, everyone, for coming out tonight. For those of you who don't know me, my name is Debbie Graber. I'm the president of Fragasso Financial Advisors, and we're so happy to see so many brave souls leave their homes and get through the snow to get here tonight. Luckily, we had some decent weather, so I appreciate that. Doug went over a lot of very valuable information, and you've got some packets as well that have additional information related to the Roth IRAs. But as Doug said, each of your situations really is unique, and so I highly encourage you to talk to your financial advisor about your situation. We will want to gather a lot of information. Hopefully most of it we have already. Some of it you might have to do a little homework on. But when we can put that all together, we have new software, so we have the technology, to run different scenarios and give you some ideas on what might make sense for you. But then we also like to coordinate with your tax advisors to make sure that we're all on the same page, regardless of whether or not you're looking to plan for a more secure and tax-efficient retirement, or maybe you're looking to pass along more tax-free monies to your kids or grandkids. There are some really creative strategies we can employ if especially it's going to be a low-income year this year or next year, but that might not be the case in future years. So please talk to your advisor tonight, next week. If you've got friends or family members who have similar questions about Roth IRAs, because it is a new concept this year because a lot of folks weren't able to have this conversion conversation or opportunity in previous years, please have friends, family, call the office. We'd be happy to help them as well. I want to thank you for your confidence, for your trust, and for your loyalty, because without wonderful clients like you, we wouldn't exist. So thank you.